7 methods to account for interest on a loan. Have you ever taken out a loan, maybe for your car, your home, or your business, and wondered how exactly do I record the interest part correctly? You're not alone. Interest is one of the most common expenses we all face, yet it's also one of the most misunderstood in accounting. Get it right, and your books stay accurate, your taxes stay fair, and you'll know exactly what your money is doing. Get it wrong, and small mistakes can quietly pile up into confusion or even penalties. In today's video, we're going to break down 7 simple and professional ways to account for interest on a loan. Whether you're a student learning accounting, a business owner managing cash flow, or just someone trying to understand your bank statement, this will make the whole process clear and practical. We'll start with the basics and build up step by step. Here's a quick preview of what's coming. 1. The straight line interest method. Simple, predictable, and perfect for short-term or flat rate loans. 2. The effective interest rate method. The gold standard under GAAP and IFRS, showing the true cost of borrowing. 3. The accrual basis method, recording interest as it's earned or incurred even before cash changes hands. 4. The cash basis method, straightforward and ideal for individuals or small businesses, tracking real payments only. 5. The amortized cost method, professional and precise, often used in corporate or banking environments. 6. The prepaid interest and adjusting entries method, for cases where you pay interest in advance and need to spread it correctly over time. 7. The compound interest recognition method, when your interest itself earns more interest, making accurate tracking essential. Each of these methods has its purpose, strengths, and a few trade-offs. By the end of this video, you'll understand how each one works, when to use it, and which method fits your situation best. So grab your notepad, and as you watch, I want you to comment below. Which of these 7 methods do you think is the most practical for you, and why? Your answer might help someone else in the community who's figuring out the same thing. Let's dive in, starting with the most common and easiest method I normally use. Method 1, straight line interest method. Let's begin with the simplest and most beginner-friendly approach, the straight line interest method. This method treats loan interest as a flat, predictable cost spread evenly across every period of the loan. It's one of the easiest techniques for both personal finance tracking and small business accounting because it doesn't require complex schedules or changing calculations. To understand it clearly, think of interest as the rent you pay for using borrowed money. Instead of letting that rent fluctuate from month to month, the straight line approach smooths it out so that each accounting period carries exactly the same interest expense. That consistency helps with planning, budgeting, and comparing results across periods. Here's how it works. You take the total interest you'll pay over the entire loan and divide it by the number of periods you'll be making payments in. The formula is straightforward. Total interest, number of periods, periodic interest expense. So, if you know your loan's total interest, you can easily determine what amount to record every month, quarter, or year. Let's go through a hypothetical example. Imagine a small landscaping company takes out a $24,000 business loan to buy new equipment. The lender charges a fixed total interest of $2,400 for a 1-year repayment term. The business agrees to make 12 equal monthly payments. Using the straight line method, the accountant divides the total interest of $2,400 by 12 months. That gives a consistent $200 in interest expense each month. It doesn't matter that the company is gradually reducing the principal. For accounting purposes, every month carries the same $200 charge. Now, how would this look in the books? Each month, the journal entry would be debit interest expense $200 credit cash, or interest payable $200. If the company pays the lender right away, they credit cash. If the payment is scheduled for later, they credit interest payable. Either way, the entry recognizes that the business owes or has paid for the cost of borrowing money. This method is very appealing to small businesses and sole proprietors who don't have accounting software or staff to manage complex calculations. It also works perfectly for flat rate loans, situations where the interest doesn't depend on a reducing balance. That could include installment plans, short-term supplier financing, or even a 1-year personal loan. Another advantage is that it creates predictability. Every month looks the same, making it easier to plan for cash flow and to show lenders or investors a steady pattern of expenses. It's also easy to audit. Anyone looking at your books can instantly see the logic behind each entry. However, the straight line method does have its limitations. Real-world loans usually calculate interest on the declining principal balance, meaning the interest portion naturally shrinks over time as you repay what you owe. By spreading interest evenly, the straight line approach ignores that decline, which makes it slightly less accurate. In financial reporting terms, that means you might overstate interest early on and understate it later. Let's extend our example to visualize this. Suppose the same landscaping company wanted to see the difference compared with a typical reducing balance loan. If their $24,000 loan carried a true 10% annual rate on a declining balance, the first month's interest would be around $200, but by the final month it might drop to only $20 or $30. Under the straight line approach, they'd still record $200 every month, even though the actual cost of borrowing is decreasing. That's why this method is sometimes called a flat rate or simplified model. It prioritizes ease over precision. For small enterprises, the trade-off is worth it. If you don't need to meet GAAP or IFRS standards and your loan terms are fixed, this method keeps your records neat and your reports consistent. It's also helpful for internal budgeting. Knowing that $200 will hit your expense line every month gives you a clear picture of operating costs. You can also apply the same concept to personal finances. Let's say you borrow $6,000 to renovate your home with a fixed total interest of $600 over 6 months. That's $100 per month. Each month, you'd record a $100 interest expense in your ledger or tracking app, exactly the same every time. At the end of 6 months, your total interest recorded equals the total interest paid. It's simple, clean, and consistent. So, to summarize, the straight line interest method is all about consistency and simplicity. It gives you a uniform expense pattern, it's easy to compute by hand or in Excel, and it provides clarity for anyone reviewing your financials. Its main drawback is that it doesn't mirror the way most real-world loan interest actually behaves, but for short-term, fixed-cost borrowing, it's perfectly adequate. In accounting, sometimes the best method is the one that keeps you organized, not the one that's mathematically perfect. If you're a small business owner, a student accountant, or someone managing personal debt, this approach can help you stay consistent and confident while you learn more advanced methods later on. And now that you've mastered the basics of the straight line interest method, we'll move on to the next technique, one that provides a more accurate picture of your true borrowing cost over time. The effective interest rate method, often called the true cost method. This approach goes deeper. It doesn't just spread interest evenly. It recognizes that as you pay down a loan, the portion of each payment covering interest gradually decreases while the portion reducing principal increases. That makes this method more accurate, more reflective of real economics, and the preferred approach under both IFRS and GAAP for long-term financial reporting. To understand why, imagine a loan as a living number, not fixed, but shrinking with every payment. Each month you owe slightly less, so the interest charged on that smaller balance also goes down. The effective method captures that changing relationship between principal and interest perfectly. Interest expense, or my carrying amount x effective interest rate. The carrying amount is whatever principal remains at the start of the period, and the effective rate is the real annual rate after considering fees, discounts, or compounding effects. Let's work through a clear example. Suppose a small construction company takes a $10,000 loan with an annual interest rate of 10%, payable over 5 years in equal annual installments. Using a standard amortization schedule, the first year's interest is 10% of $10,000, which equals $1,000. After the first payment, part of that payment reduces the principal, let's say by $1,700, leaving a new balance of $8,300. Next year, interest is no longer $1,000. It's 10% of $8,300 or $830. By year 5, the interest portion is tiny because the principal is almost gone. That decreasing pattern is exactly what the effective interest rate method records. Every period's interest expense calculated on the current loan balance, not the original one. Now let's imagine how this looks in journal entries. At the end of the first year, the company recognizes its interest cost like this. Debit interest expense, $1,000 credit cash, or interest payable, $1,000. When part of the payment goes toward principal, that's recorded separately. Debit loan payable, $1,700, credit cash, $1,100. Next year, when the balance is $8,300, the interest expense entry becomes debit interest expense $830, credit cash $830, and so on, with the interest shrinking each period. Over time, these entries show a realistic picture. Interest starts high and gradually fades as the debt is paid down. This matches how lenders actually calculate interest and how banks view repayment schedules. Another important use for the effective interest rate method is when loans include fees, discounts, or additional costs. For example, if a $10,000 loan includes a $200 processing fee, you technically receive only $9,800 in cash, but you still owe interest on $10,000. The effective rate, therefore, is slightly higher than the stated rate, because you're paying interest on money you didn't fully receive. This method captures that nuance automatically, spreading the real cost of borrowing over the entire loan term. Let's look at a longer hypothetical scenario to see this method in motion. Imagine a medium-sized furniture business borrows $50,000 to expand its showroom. The nominal annual interest rate is 8%. and the loan will be repaid over 5 years in equal annual installments. At 8%, the first year's interest on $50,000 is $4,000. After the first payment, the principal drops to $41,000. Next year's interest is 8% of $41,000. That's $3,280. The third year, the balance falls to $3,100. Interest now only $2,520, and so on. By year 5, the interest is almost negligible. In accounting terms, the business records an interest expense each year equal to that period's calculated amount. $4,000, then $3,280, then $2,520, rather than an even average. When these amounts are plotted on a chart, the line curves downward, illustrating the real cost of borrowing declining over time. That's why this approach is called effective. It mirrors what actually happens in your loan statement. Now, there are advantages and a few challenges with this method. The advantages are clear. It gives the most accurate picture of how interest behaves. It complies with major accounting standards. It properly matches expense recognition with the loan's outstanding balance, which helps financial statements tell the truth about performance and cost. On the other hand, it requires more work. You need an amortization schedule, or at least a spreadsheet, to keep track of changing balances. Without software, that can be tedious, especially for monthly payments or variable rate loans. Still, the payoff is accuracy. Investors, lenders, and auditors prefer this method because it avoids distortion. They can look at your statements and see exactly how your debt is reducing and how your cost of borrowing evolves. It also helps with interest expense forecasting. By projecting declining interest over future periods, you can plan your cash flow more precisely. You'll know that the first year or two are heavier on interest, while later years free up cash as interest costs shrink. That's valuable information for budgeting and business strategy. In personal finance, you can apply the same logic. Take a 5-year car loan of $20,000 at 9% interest. Your early payments are mostly interest, often 60 to 70%, while the last payments are mostly principal. Understanding that pattern helps you see why refinancing early or making extra payments saves you money, because you cut down the balance while the interest portion is still large. That's the same insight the effective interest rate method gives accountants when managing loans on a balance sheet. Now let's contrast this with method 1, straight line interest method. Under the straight line approach, that same $50,000 furniture loan at 8% would show $4,000 interest every year for 5 years, totaling $20,000. But the real numbers under the effective interest rate method might be $4,000, then $3,280, then $2,520, or $960, and $1,000, still totaling roughly $12,560, but distributed according to actual loan behavior. That difference affects profit recognition, tax calculation, and even management decisions about refinancing. When it comes to compliance, most large organizations, especially banks and corporations, are required to use the effective method for loans, bonds, and long-term liabilities. It ensures that reported interest expense truly reflects economic cost, not just an arbitrary average. So, to summarize, the effective interest rate method measures the real cost of borrowing by applying a consistent rate to the remaining loan balance each period. It's precise, it aligns with accounting standards, and it paints a faithful picture of financial reality. While it's more complex to maintain, the insights it gives, especially for long-term debt, are invaluable. If you're managing a business loan, investment bond, or any liability that lasts several years, this is the method you'll eventually want to master. It tells you not only what you owe, but how your cost of debt evolves as time and payments work in your favor. And that's the beauty of the effective interest rate method. It transforms interest from a flat number into a living measure of progress. Once you understand it, you'll never look at a loan statement the same way again. Next, we'll build on this accuracy and explore a method that fits between simplicity and compliance, where timing and recognition matter just as much as calculation. 3. Accrual basis accounting. It's one of the most important principles in professional accounting. Unlike the previous methods, this one isn't about how much interest you pay, but when you recognize it. Accrual basis calculation formula is net income equals cash receipts minus cash payments, add change in accounts receivable, minus change in accounts payable, add change in accrued expenses, minus change in prepaid expenses, add change in unearned revenue. Under the accrual principle, businesses record income and expenses when they are earned or incurred, not when the money actually moves. That means interest expense is recognized the moment it accumulates, even if no payment has been made yet. Think of it like this. Every day that passes while you owe money, a small portion of interest silently builds up. Even if you don't pay it right away, it has already become a cost of doing business. The accrual method ensures that this cost appears in the correct accounting period, giving a true picture of how much the loan has really cost you so far. Imagine a company called Green Tech Supplies. They take a short-term loan of $120,000 at an annual interest rate of 10% with payments every 6 months. That means $6,000 of interest is due every half year. Now, GreenTech's fiscal year ends in March, but their next interest payment isn't due until June. If they waited until June to record that $6,000 payment, their March financial statements would look better than they really are. Under accrual accounting, however, they calculate the amount of interest that is already accumulated by March, 3 months' worth, and record that expense right away. 3 months out of 6 is half of the $6,000, or $3,000. So, the accountant records, debit interest expense $3,000, credit interest. Payable $3,000. When June arrives and the full $6,000 payment is made, the company debits interest payable for $3,000, debits interest expense for another $3,000, and credits cash for $6,000. This process matches costs to the period they belong to, a concept known as the matching principle. The matching principle is what makes accrual accounting so powerful. It ensures that the financial statements reflect reality rather than timing. If the loan funded operations that earned revenue in March, then March should also include the related interest expense. Without that adjustment, profits would appear inflated for one period and lower in the next. Let's look at a more vivid example. A small property developer, Riverside Real Estate Limited, takes a 2-year construction loan of $500,000 at 8% interest, payable quarterly. Almost every medium or large organization uses the accrual method because it provides a consistent, truthful view of performance. It's also required by GAAP and IFRS, the 2 main global accounting standards. Banks, investors, and regulators rely on this accuracy because it prevents financial results from being distorted by the timing of payments. There are clear advantages to this approach. First, it gives a precise reflection of what's truly owed and when it was incurred. Second, it provides stability in reporting, allowing comparisons across different periods. And third, it satisfies professional and legal requirements for financial reporting. However, the accrual method does add a layer of complexity. It requires monthly or quarterly adjustments to record unpaid interest and to reverse them when payments are made. If you miss those adjustments, your books can quickly become inaccurate. For smaller businesses or individuals, that may feel like extra work, but for larger entities, it's essential for maintaining credibility. There's also a psychological challenge. Because interest is recognized before payment, a company might show significant expenses on paper even when no cash has yet left the account. It can be confusing at first, but it teaches a valuable lesson. Accounting isn't just about cash, it's about obligations. To make it more relatable, consider a personal example. Suppose you have a $10,000 personal loan at 12% interest, with payments due every 3 months. Each quarter's interest is $300. If your year ends after 2 months, 2/3 of that interest, or $200, has already accrued. Even if you haven't paid it yet, that $200 should be recognized in your records as an expense and a payable. When the actual payment is made, you clear the payable account. That simple act, it keeps your financial picture complete and up to date. Compared with the previous methods, accrual accounting focuses on timing. The straight line method spreads total interest evenly, and the effective interest rate method calculates interest on the remaining balance. The accrual basis method, however, answers a different question. When does this cost truly belong? In practice, you can even combine methods, calculating interest using the effective rate but recording it under accrual timing. The first determines how much, and the second determines when. For internal management, the accrual method is an invaluable planning tool. By tracking interest that has accrued but not yet been paid, you can forecast upcoming payments and manage your cash flow more strategically. The interest payable account acts as an early warning system, showing what's coming due before it hits your bank balance. In simple terms, the workflow looks like this. When interest accumulates but hasn't been paid, you debit interest expense and credit interest payable. When you finally pay the lender, you debit interest payable and credit cash. Those 2 entries ensure your expense is matched to the right period, and your balance sheet accurately reflects both the debt and its repayment. Accrual accounting respects time. It treats interest as a cost that grows quietly in the background, even if you haven't yet paid it. That respect for timing is what makes your financial information reliable and fair. It prevents surprises at year-end, avoids misstating profit, and helps decision makers see the full financial picture. So, while it may take more effort to maintain, the accrual basis method is the standard for good reason. It bridges the gap between daily operations and long-term financial truth. It tells you not just what you've paid, but what you owe. And that awareness is the foundation of responsible accounting. 4. Cash basis accounting. Now that we've seen how the accrual basis method recognizes interest as it's incurred, let's look at its opposite, the cash basis method. This method is as straightforward as accounting gets. Under cash basis accounting, nothing is recorded until money physically changes hands. You record income only when you receive it, and you record expenses only when you pay them. It's simple, intuitive, and widely used by small businesses, freelancers, and individuals who just want to track real cash flow without complex adjustments. In the context of loans, the cash basis method means you recognize interest expense only when you actually pay it. No entries for accrued interest, no adjusting for unpaid months, and no future liabilities on your books until payment day arrives. If cash hasn't left your account, the transaction simply doesn't exist yet in your financial records. Let's look at how this works in practice. Imagine a small photography studio called Bright Frame Media. They take out a $20,000 equipment loan with an interest rate of 10% per year, payable every 6 months. Each payment includes both principal and interest. Under the cash basis, Bright Frame doesn't record any expense during the months leading up to that first payment. Even though interest is technically accumulating, it's ignored until the day the business pays the bank. So, when 6 months pass and the business pays $1,000 in interest, that's when the accounting entry is made. Debit interest expense, $1,000. Credit cash, $1,000. It's as simple as that. There's no interest payable account, no accruals, and no adjusting entries at the end of the month or year. This simplicity is what makes the cash method appealing. For small operations that just want to know how much money they spent and received, it keeps things easy. You can open your records and immediately see your real cash position. There's no need to explain why your books show an expense you haven't paid yet, or why your profit looks lower due to non-cash entries. However, that same simplicity also hides some of the reality. Because the cash method ignores unpaid interest, it can distort the true picture of your financial health. Imagine that Bright Frame's year ends in December, but their first interest payment isn't due until February. Their income statement for the year would show zero interest expense, even though they've already used the bank's money for 6 months. The following year, they'd suddenly show double the interest expense when the payment is made. The result is uneven, misleading financial results that don't reflect what's actually happening over time. Let's look at another example, this time for personal finances. Suppose you take a $5,000 personal loan with an annual interest rate of 12%, payable monthly. Under cash basis accounting, you record an interest expense only on the days you make payments. So, if your monthly payment includes $50 of interest, you simply record interest expense, $50, cash, $50 every time you make that payment. It's that simple. You never show an interest payable balance. You never record interest that hasn't yet been paid. Your financial record stays clean and focused only on real cash movements. This approach works well for individuals who want to track their budget or businesses with very basic accounting needs. It's often used by sole proprietors, small traders, or people who file simplified tax returns. For tax purposes, many jurisdictions even allow the cash basis for entities with limited revenue, because it's easier to verify when actual money was spent or earned. Still, it's important to understand what you give up when you choose this method. The biggest limitation is accuracy over time. Since the cash basis method only recognizes interest when paid, it doesn't capture financial obligations that already exist. That means you might think you're more profitable than you really are simply because you haven't paid your expenses yet. In other words, your business could look healthy on paper while silently accumulating liabilities. Another limitation is that it doesn't comply with GAAP or IFRS for larger companies. These standards require that expenses be recorded when incurred, not when paid. So, while cash basis accounting is fine for personal budgets and small firms, it's not accepted for audited or publicly reported financial statements. Let's consider a more detailed hypothetical to show how the two methods differ. Say, a small construction company takes out a $100,000 loan at 10% interest, payable quarterly. That's the key difference. Cash accounting shows when money leaves your hands. Accrual accounting shows when the cost was created. Despite its limitations, the cash basis method has one undeniable advantage: clarity. It tells you exactly how much cash went out for interest during a period, which is valuable for managing liquidity. You know immediately whether you can afford your payments without worrying about future accruals or adjusting entries. Many small business owners find comfort in that simplicity. They can open their bank statement, see their loan payment, and record it directly. No estimates, no reversals, no confusion. For day-to-day operations, it keeps financial management less intimidating. There's also a psychological benefit. Because you only record expenses when you pay them, your books never show negative balances for unpaid interest. Everything you see has already been handled. For someone new to accounting, that sense of control and simplicity can make bookkeeping less stressful. However, when your business grows or you start dealing with multiple loans, vendors, or longer repayment schedules, the cash basis method can become misleading. Without recognizing interest that is already accrued, you risk underestimating your costs or overestimating your profit. At that stage, most accountants recommend transitioning to the accrual system for a more complete view. In summary, the cash basis method records interest only when it's paid. It's simple, clear, and great for beginners or very small entities that care more about cash flow than detailed accuracy. but it doesn't reflect true profitability or obligations in real time. If you think of accounting as a story, cash basis tells the story of what has happened, while accrual accounting tells the story of what is happening. Both are useful, but for different purposes. So, when should you use the cash basis method? It's best for tracking personal loans, small service businesses, or side projects where you just need to monitor spending, not prepare formal statements. For startups, freelancers, and individuals, it offers clarity and peace of mind. But for growing companies or anyone presenting financial statements to others, accrual remains the gold standard. The key takeaway is this: cash shows movement, accrual shows meaning. Both tell a story, but cash basis gives you the short version, straightforward and immediate. 5. Amortized cost method. We've now explored the simpler ways of recording interest, the straight line, effective, accrual, and cash basis methods. This method is often used by professional accountants, banks, and large organizations because it combines accuracy, structure, and consistency. It doesn't just calculate interest, it tracks how both interest and principal change together over time. The word amortized simply means gradually written off. In accounting terms, it means spreading the cost of borrowing evenly and systematically over the life of a loan, recognizing both interest expense and principal repayment in each period. Think of a loan not as one big lump of money to pay back someday, but as a series of smaller, predictable payments. Each payment has two parts: one portion that goes toward paying interest, the cost of borrowing, and another portion that reduces the loan's outstanding balance. The amortized cost method captures this relationship accurately, helping you see exactly what part of each payment represents expense versus debt reduction. To understand it clearly, let's start with a simple example. Imagine a company borrows $50,000 at an annual interest rate of 8%, repayable over 5 years in equal annual payments. Using an amortization schedule, each payment might be around $12,520 per year. In the first year, interest is calculated on the full $50,000, so that's $4,000 in interest. The rest of the payment, about $8,520, reduces the principal. Now, in the second year, the interest is calculated on that smaller balance. 8% of $41,478, which equals $3,318. That means more of the second payment goes toward principal, around $9,204 this time. With each passing year, the interest portion gets smaller and the principal portion grows until the loan is completely paid off in year 5. From an accounting perspective, the entries for each payment would look like this. When the annual payment is made, you record debit interest expense for that period's interest portion, debit loan payable for the principal portion, and credit cash for the total amount paid. Over time, this reduces both your interest expense and your loan balance systematically. What makes this method powerful is that it mirrors how real loans work in practice. Every bank, mortgage lender, and financial institution uses amortization schedules to calculate repayments. They do this not only to ensure consistency, but also to keep accurate financial reporting. That's why the amortized cost method is the preferred approach for long-term debt and investments like bonds or lease liabilities under accounting standards such as IFRS 9 and ASC 310. Let's look at a more detailed hypothetical scenario to make this clearer. Suppose a manufacturing company called Silvertech Industries takes out a $100,000 loan at a 6% annual interest rate for 4 years. Year 1, interest, $6,000. Principal repayment requires $20,074, balance $77,126. Year 2, interest, $4,664, principal repayment $23,610, balance $54,116. Year 3, interest, $3,247, principal repayment $25,27, balance $20,089. Year 4, interest, $745, principal repayment $25,29, balance $100. Each year, Silvertech records an interest expense equal to that period's interest calculation and reduces the loan liability by the principal amount repaid. By the end of year 4, the loan is fully settled, and the financial statements show exactly how much interest was paid in total and how much principal was reduced each year. From a reporting perspective, this method is incredibly informative. It shows the true cost of borrowing across the loan's life and maintains the link between the income statement and the balance sheet. On the income statement, the interest expense gradually decreases each year, while on the balance sheet, the loan balance steadily declines until it reaches 0. The advantages of the amortized cost method are clear. First, it's accurate. It captures the true relationship between interest and principal, giving a faithful picture of how debt behaves over time. Second, it's structured. The amortization schedule provides a roadmap for every payment, making forecasting and analysis easy. Third, it's compliant. It meets international accounting standards, making it essential for external reporting, especially for banks, corporations, and public entities. However, this method also has challenges. It requires detailed calculations and ongoing tracking. especially if the loan has changing interest rates or additional fees. For each period, you must recalculate the interest based on the current carrying amount of the loan. That means you need either accounting software or a spreadsheet with an amortization table to do it efficiently. It's not something you can easily maintain by hand for multiple loans at once. There's also a conceptual challenge. Unlike the straight line method, where interest is constant, or the cash basis, where you record only what's paid, the amortized cost method demands precision at every step. You can't simply divide total interest evenly or delay recognition. You must know exactly how much interest and principal are embedded in each payment. Still, the effort pays off. For example, when an investor or auditor reviews your books, they can see exactly how much debt you've repaid, how much remains, and what portion of past payments represented borrowing costs. It tells the complete story of the loan from beginning to end. In personal finance, this method is also useful if you want to understand your mortgage or car loan better. When you look at your loan statement and see how early payments are mostly interest, while later ones go mostly toward principal, that's the amortized cost method in action. It helps you see why making extra payments early in the loan term saves money, because it cuts down the balance faster, reducing the total interest you'll pay over time. Let's look at a quick personal example. Suppose you take a $30,000 car loan at 9% interest for 5 years. Your monthly payment might be about $620. In the first month, $225 of that payment is interest, and $397 goes toward reducing the balance. By the final year, only about $40 is interest, and the rest is principal. The amortized cost method would track each of those monthly changes to show exactly how much interest expense you, enfant V, incurred, and how your loan liability has decreased over time. This method also plays a vital role in financial planning. Because you can see your declining interest cost each period, you can forecast future expenses more accurately. Companies use these schedules for budgeting, profitability analysis, and cash flow planning. When your interest expense is predictable, you can make more informed decisions about refinancing, expansion, or early repayment. To summarize, the amortized cost method represents the professional standard for tracking loan performance over time. It reflects both the passage of time and the reduction of debt with precision. It tells a story of gradual progress, how every payment not only reduces what you owe, but also decreases your future costs. Compared to earlier methods, it strikes a balance between realism and structure. The straight line method is simple but flat. The effective interest rate method is accurate but focused on interest only. The amortized cost method combines both, showing you the real journey from debt to freedom, step by step. In accounting, this method reinforces an important truth. Every loan payment is more than just money leaving your account. It's a mix of cost and recovery, a transaction that shapes your financial position over time. Understanding that mix is what separates bookkeeping from real financial insight. So if you're managing long-term loans, mortgages, or corporate debt, this is the method that gives you the clearest picture. It aligns with international standards, helps you plan better, and builds transparency in your financial reporting. 6. Prepaid interest and adjusting entries. Not every loan charges interest after time has passed. Some lenders collect their interest in advance, before you've even started using the money. That's where the prepaid interest and adjusting entries method comes in. This approach handles situations where the borrower pays interest early, making sure the expense is recorded gradually over the period it actually applies to, rather than all at once. It's a method that keeps your financial records balanced and your income statements accurate over time. When you pay interest up front, it's not an expense yet. It's what accountants call a prepaid asset, because you've paid for a benefit you'll receive in the future, the right to use borrowed money over time. As the months go by, that prepaid interest slowly turns into an expense, reflecting the passage of time. This is the essence of adjusting entries. Small, precise updates that ensure your books stay aligned with reality. Let's start with a simple example. Suppose you take a 6-month business loan and the lender deducts $600 in interest up front. Even though you've already paid the money, the expense hasn't been used up. At the start, you would record prepaid interest $600 as an asset, reducing your cash by the same amount. Then, as each month passes, you move $100 from prepaid interest to interest expense, spreading the cost evenly over 6 months. By the time the loan matures, your prepaid account will be empty, and your total recorded expense will equal the full $600, perfectly matched to the time you held the loan. This process prevents your first month from looking overly expensive. Without it, your profit or loss could look worse in the beginning and better later, even though nothing about the loan actually changed. The prepaid approach smooths out that timing difference, showing your true cost for each period. Here's another practical scenario. Imagine a company called Harborline Imports takes a $120,000 loan at 10% annual interest, but the bank requires the first 3 months of interest, $3,000, to be paid up front. For lenders, this situation works in reverse. If a bank collects interest in advance, it can't count that money as income right away. It hasn't yet been earned. Instead, the bank records it as unearned interest revenue, which sits as a liability on their balance sheet. Each month, as time passes and the bank earns the interest, it reduces that liability and recognizes interest income. In short, the borrower's prepaid interest is the lender's unearned income. The key to keeping this method accurate is making adjusting entries. These are the end of month or end of quarter updates that shift part of a prepaid item into an expense. Without them, your books would quickly go out of sync with time. For instance, if you forgot to adjust, your balance sheet would still show prepaid interest that no longer exists, or your income statement would miss expenses that should have been recognized. That's why adjusting entries are a cornerstone of good accounting practice. Now let's look at a larger example. The bank deducts $20,000 of interest up front to cover the first 4 months. The benefits of this approach are clear. It prevents overstating expenses in one period, aligns perfectly with the matching principle, and provides a smoother trend of results over time. It also gives managers and investors a more realistic picture of how costs evolve. Prepaid interest stays visible as an asset until it's used up, making it easy to see how much value remains from what was paid up front. Of course, this method requires discipline. You have to remember to make those adjusting entries each period. Otherwise, your statements will drift from reality. For businesses that handle multiple loans or prepayments, automating these adjustments through accounting software is often the best solution. Here's how it might look for personal finances. Imagine you take a $6,000 personal loan and the bank deducts $600 in advance for 6 months' interest. From a financial reporting standpoint, this method also improves comparability. When companies pay large sums of interest up front, spreading that cost prevents spikes in their expense charts. It helps analysts and auditors understand performance without being distracted by timing differences. For lenders, it maintains honesty in revenue reporting, ensuring interest is recognized only as it's earned. In essence, prepaid interest and adjusting entries are all about fairness and timing. They respect the fact that money's value unfolds over time, and accounting must follow that rhythm. Paying early doesn't erase a cost. It simply shifts when you recognize it. By recording prepaid interest as an asset and gradually expensing it through adjusting entries, your books reflect reality, not just transactions. This method teaches an important lesson. Accounting isn't just about tracking money, it's about tracking time and value. It reminds us that every financial event stretches across periods, and only careful timing turns raw numbers into truth. 7. Compound interest recognition. If you've ever heard the phrase interest on interest, you already understand the essence of compound interest recognition. It's the final and most dynamic method of accounting for interest, the one that truly shows how debt grows or investments multiply over time. Unlike simple interest, which is calculated only on the original principal, compound interest builds on itself. Each period's interest is added to the balance, and the next round of interest is calculated on that new total. In other words, interest earns interest. This method is common in long-term loans, savings accounts, and bonds, where payments aren't made frequently or interest is allowed to accumulate. From an accounting perspective, it's crucial to recognize this growth properly, not just to record how much is owed today, but how that amount changes as time passes and compounding takes effect. Let's start with a basic idea. When interest compounds, the formula shifts from the simple pattern we've used before. The calculation becomes A is equals P, multiply into bracket. 1 add R over N to the power of NT, where A is the final amount, P is the principal, R is the annual interest rate, N is the number of compounding periods per year, and T is time in years. The difference may look small on paper, but over time, it's massive. Compounding turns linear growth into exponential growth. And that's why it's often called the most powerful force in finance. Imagine you take a $10,000 loan at 10% annual interest, compounded monthly. Under simple interest, 1 year later, you'd owe $11,000, $10,000 principal plus $1,000 interest. From an accounting perspective, the challenge is keeping your books in step with that growth. Each period, you have to recognize not only the interest for that interval, but also the fact that the balance, your principal plus prior interest, has now changed. Let's go through a more structured example. Suppose a company called Metro Build Construction takes a $100,000 loan at 8% annual interest, compounded quarterly for 3 years. Every quarter interest is added to the loan balance, not paid immediately. The accountant must record that compounding effect each period, even though no cash changes hands. At the end of the first quarter, interest is $2,000, 8% divided by 4 quarters, which is equal to 2% per quarter. The company records debit interest expense $2,000, credit loan payable $2,000. The new loan balance becomes $102,000. Next quarter interest is 2% of that new amount. That is $2040, slightly higher. The entry repeats, growing a little each time. By the end of 3 years, the total owed becomes about $125,973. That extra $973 came from interest on interest, a real cost that must be recognized in the financial records. This compounding process is particularly important when payments are deferred. Some corporate bonds, for example, accumulate interest for several years before any payment is made. The accountant must record each period's compounded interest as an expense and as an increase in the liability, even though the company hasn't yet paid it out. This keeps the balance sheet honest and the income statement reflective of true costs. The journal entries for compound interest recognition are simple in structure, but powerful in effect. Every compounding period, you record debit interest expense for the amount of interest accrued that period, and credit loan payable or interest payable for the same amount. When payment eventually happens, you reverse that liability by debiting interest payable and crediting cash. The cycle repeats for each period, with the amounts gradually increasing as the loan compounds. Now, let's make this more vivid with a real-life scenario many people can relate to, a credit card balance. Suppose you owe $5,000 and the card charges 20% annual interest, compounded monthly. That's roughly 1.67% per month. That's why accountants and financial educators stress the importance of recognizing compounding in reports and personal finances. Ignoring it can make liabilities look smaller than they really are. Over time, that error can snowball into major discrepancies between reported and actual balances. Let's also consider the flip side, investments. For investors, compound interest is a benefit, not a burden. Suppose a company deposits $50,000 in a fixed income investment at 6% annual interest, compounded quarterly. Every quarter, it earns 1.5% on both the original principal and prior interest. The company records interest income each period, even if the cash isn't withdrawn. That recognition keeps the income statement accurate and shows shareholders the true value generated by holding that investment. The advantages of the compound interest recognition method are easy to see. It's the most realistic approach for long-term loans and investments. It shows how money actually behaves over time, growing not linearly, but exponentially. It also aligns with both accounting standards and financial economics, providing the most transparent view of a company's financial obligations or earnings. But it comes with complexity. You need precise calculations and accurate timing. Each compounding period must be recorded even if payments are deferred. Without automated accounting software, tracking multiple compounding loans can quickly become overwhelming. In financial reporting, this method is essential for instruments like bonds, notes payable, and certain lease liabilities. It ensures that the carrying amount of the liability or asset always reflects the effect of time and compounding. For auditors, this accuracy is critical because it confirms that the financial statements represent the true economic cost or benefit of holding that position. On a personal level, understanding compound interest changes how you view debt and savings. It's what turns small credit card balances into big problems when left unpaid, but it's also what turns regular savings into wealth when left to grow. In accounting terms, compound interest recognition helps visualize that process. Every period adds a little more, building momentum. To summarize, the compound interest recognition method is about acknowledging the full financial reality of time. It recognizes that interest doesn't just sit still, it multiplies. By recording each period's compounded growth as both an expense and a liability, accountants show how obligations evolve and why managing them early matters. Compared with earlier methods, compound interest recognition captures the living nature of money. The straight line method is predictable. The effective interest rate method is accurate. The amortized cost method shows repayment, and the prepaid interest method manages timing. But this one shows movement, growth, and acceleration. It's how accounting meets the mathematics of finance. So whether you're an accountant, a business owner, or simply someone managing personal debt, understanding compound interest helps you see the real engine behind financial change. It teaches a simple truth. Time is either working for you or against you. When you understand how to record it and control it, you stop being surprised by how fast money grows and start using that power to your advantage.